Most people only panic when silver spikes and then dumps. But today, the most important thing is that it didn't dump. Shanghai just printed above $115 in silver, and the chart is calm. Not quiet because nothing happened. Quiet because the market accepted higher prices. Hello everyone, AG here. Quick note before we start, this is educational, not financial advice. I'm not a bank, not a fund, not managing anyone's money. I'm tracking the silver market in real time and showing receipts. You decide what it means for you. Today is one proof, one conclusion. We're going to read this Shanghai silver chart like a detective reads a case file, because when the crowd gets emotional, the only thing that matters is what the market actually did. And by the end of this breakdown, you'll have a simple framework for tracking whether this move is spreading or whether it fades as noise. Here's the proof. This is silver in China, SHFE futures, symbol AG. And we're working with the numbers on this move as follows. After a major jump on Thursday of about 8.5%, silver added roughly another 6.5% on Friday in Shanghai, reaching around $115.55 per ounce, or roughly 25,867 yuan per kilogram. Now let me be clear, the exact number is impressive, but what this chart shows is more important than the headline itself. Because lots of markets can spike. The question is, do they hold? Watch the behavior. The price pushes up early, then it holds most of those gains instead of giving them back. No dramatic collapse, no spike and dump signature, no violent rejection. In stressed markets, the first thing you usually see after a big move is panic. Either buyers get exhausted and price collapses, or sellers attack and force a sharp reversal. Here, you don't see that. You see holding, and holding after a sharp move is the market saying something simple. We're okay up here. Let me explain why this matters more than the headline number. Markets reveal their true state not through dramatic moves, but through how they handle those moves afterward. A spike to 115 followed by immediate collapse back to 100 would tell you the market rejected that level. Buyers push too far, sellers overwhelm them, and equilibrium remains lower. But a spike to 115 followed by consolidation at 112 to 115 tells you something completely different. It tells you the market can live at these levels. This is acceptance. And acceptance is the foundation for continuation. You cannot build a second leg higher if the first leg gets rejected. The market must prove it can sustain new levels before attempting even higher levels. What we're seeing in Shanghai is that proof developing in real time. The price moved dramatically higher and then stabilized rather than collapsing. That stabilization is the market's way of saying these prices are workable, not extreme. Now look at the volume bars underneath the price action. Volume is active during the rise, and then it cools as the price stabilizes. That combination matters enormously. When you see volume expand during the push and then calm down while price stays elevated, it usually means buying came with intention. It wasn't a fluke, and sellers didn't overwhelm the move after it happened. In plain language, buyers stepped forward, price moved, and the market didn't immediately punish them for it. The absence of punishment is itself information. It tells you that sellers are not aggressively defending lower levels. It tells you that participants who witnessed the move are not rushing to fade it. It tells you the market's collective judgment is that 115 is reasonable given current conditions. This is why volume analysis matters as much as price analysis. High volume during advances confirms broad participation. The move isn't driven by a single large buyer, but by multiple participants acting simultaneously. And when volume then decreases while price holds, it suggests those buyers are not immediately regretting their decision in selling. They're content to hold positions at these levels. This is the signature of conviction, not speculation. Let me translate this in the simplest possible way. This isn't a chart that says we spiked and got rejected. This is a chart that says we moved up and we can live here. That's acceptance. And acceptance is usually what you see before the next step, not after the last one. People always expect the warning sign to be chaos, but sometimes the warning sign is the absence of chaos at a higher level. Think about what doesn't appear on this chart. There are no massive red candles showing panic selling. There are no volume spikes on down moves suggesting aggressive unloading. There are no wicks, those long tails on candles that show price briefly spiked, but was immediately rejected. The absence of these bearish signatures is as important as the presence of bullish ones. The market is not fighting these levels. It's accepting them. Now, yes, this is a futures market, but markets don't behave in isolation. And Shanghai in particular sits inside a physical and industrial ecosystem that's different from the way the West often trades metals. When Shanghai holds higher prices like this, it often lines up with something underneath. physical pull-through demand, tighter availability, hedging that's tied to real consumption, or simply a willingness to pay replacement cost instead of negotiating endlessly with a paper quote. So I'm not saying this one chart proves everything. I am saying this behavior is consistent with demand under the surface, not just speculative heat. And here's where this chart becomes more than a curiosity. It's happening in a context where other pressure points are also showing up. At the same time, you're seeing strength in silver futures in other places. You're seeing late building of open interest. You're seeing quiet delivery dynamics. You're seeing currency stress signals like USD JPY sliding, that unwind the carry trade feeling, and you're seeing trust questions rising elsewhere in the metals world, like debates around repatriation and reserves. These are not all the same thing, but they rhyme. They all point toward one theme. When stress builds, it migrates from paper to physical, slowly then suddenly. This chart fits that pattern. Let me explain what I mean by paper to physical migration, because this concept is central to understanding what's happening. For decades, silver's price was determined primarily by paper markets, futures exchanges where participants trade contracts representing silver without typically taking delivery. This system worked because it provided liquidity, price discovery, and hedging capabilities. Industrial consumers could lock in prices months in advance, miners could hedge production, investors could gain exposure without storing physical metal. Everyone benefited from the efficiency, but paper markets depend on trust. Trust that contracts can be converted to physical metal if needed. Trust that prices reflect actual supply and demand rather than just financial flows. Trust that the system will function during stress. When that trust erodes, participants shift from paper to physical. They stop accepting promises and start demanding metal. And when enough participants make this shift, paper prices lose relevance and physical prices take over as the true market clearing level. What we're seeing in Shanghai is evidence this shift is occurring. The willingness to pay $115 for silver in physical form, the holding of prices at these levels without rejection, the volume pattern suggesting conviction rather than speculation, all of this points to physical demand driving price rather than paper speculation. And once physical demand becomes the dominant force, price behavior changes fundamentally. Here's the line I want you to remember. China isn't dumping silver into this strength. The chart suggests the opposite. China is comfortable paying. You don't get fireworks immediately, you get pressure. And pressure is what breaks anchors. Let me explain what I mean by breaking anchors, because this is the mechanism through which major repricing events occur. For years, COMEX futures served as the anchor for global silver prices. When Shanghai traded at a premium, arbitrage would close the gap by buying COMEX and delivering to Shanghai. When London traded at a discount, arbitrage would close the gap by buying London and selling COMEX. This arbitrage kept global prices aligned and ensured COMEX remained the primary reference price. The anchor held, but anchors can break when the forces pulling on them exceed their holding strength. If Shanghai is willing to pay 115 while COMEX quotes 100, and if that spread persists rather than closing through arbitrage, it signals the anchor is failing. Metal is not moving from COMEX to Shanghai fast enough to close the gap. Export controls, logistics constraints, or simply lack of available metal prevent the arbitrage that would normally function, and when arbitrage fails persistently, the anchor breaks. Once the anchor breaks, price discovery shifts. Instead of Shanghai referencing COMEX, COMEX must eventually reference Shanghai. The physical market with genuine demand sets the price, and the paper market must follow or become irrelevant. This is not a quick process. Anchors don't snap suddenly. They strain, they drag, they slowly give way. But once the process starts, it's difficult to reverse because it reflects real changes in market structure rather than temporary distortions. Consequence number one is simple. When Shanghai holds higher prices instead of arbitraging them down, global supply begins to drift toward the highest bidder. That's not ideology, that's gravity. Metal flows toward the place willing to pay replacement cost. And when a large market is comfortable paying higher levels, you should expect supply to chase that demand. Think about this from a miner's perspective. You produce silver in Mexico or Peru. You have multiple buyers competing for your output. Industrial consumers in China, manufacturers in Europe, dealers in North America, investors globally. To whom do you sell? Historically, you sold to whoever offered the best combination of price, payment terms, and relationship. But if one region consistently pays $10 to $15 per ounce more than others, your decision becomes simple. You sell to that region. This supply reorientation doesn't happen overnight. You have existing contracts, long-term relationships, logistics arrangements optimized for certain trade routes. But over time, these gradually shift toward the highest bidder. New production gets allocated first to premium markets. Contract renewals favor buyers willing to pay more. Logistics networks adapt to service the most profitable destinations. And slowly, the global supply base reorients itself around the price leader rather than the historical price setter. Consequence number 2 is where this becomes structural. Western paper markets lose their anchor, slowly, because the paper quote is supposed to be the universal reference. It's supposed to be the number that says this is what silver is worth everywhere. But if a major physical and industrial region accepts a higher price and stays there, the paper quote becomes regional. It becomes a local number for a local system. And when a reference price becomes local, price discovery begins shifting, not in a single day, not with a press release, but through repeated behavior, charts that don't reject highs, spreads that don't compress the way they should, and supply that slowly migrates east. This is how hegemonic price setters lose their status, not through dramatic collapse, but through gradual irrelevance as market participants increasingly ignore their quotes in favor of prices that reflect actual transaction reality. Everyone will talk about 115. But the calm is the signal. Calm at higher prices tells you this level is not being treated like an accident. It's being treated like a floor under negotiation. Rejection looks violent, acceptance looks boring, and boring is exactly what this chart is. Let me give you the framework for understanding acceptance versus rejection, because this distinction is critical for interpreting any major price move. Markets do two things at new highs. They reject or they accept. Rejection looks like spike, wick, collapse, heavy selling pressure. You see the price briefly touch a new high, then immediately reverse on massive volume as sellers overwhelm buyers. The high becomes a clear resistance level that the market cannot sustain. This rejection signals that the move went too far too fast and equilibrium lies lower. Acceptance looks like advance, hold, light pullback, no panic. The price reaches a new high, consolidates modestly, perhaps pulls back 5 to 10%, but then stabilizes without collapsing. Volume remains moderate. Participants adjust to the new level rather than fighting it. This acceptance signals that while the move was significant, the market can sustain these levels and potentially build on them. This chart leans acceptance, and acceptance is the precondition for continuation. You can't build a second leg if the first leg gets rejected. So the real question isn't did silver hit 115? The real question is did the market accept 115? This chart suggests it did, at least so far. Now I know the temptation. You want to ask, so does it go higher on Monday? I don't do certainty, I do scenarios and signals, because markets can do anything in a single session. What matters is whether the behavior confirms. Here's what I'm watching at the open. If Shanghai opens firm and holds above key levels after the first hour, that supports continuation. The first hour is when overnight orders execute, when position adjustments occur, when the market digests news and repositions. If price holds through this volatile period, it confirms the acceptance is genuine rather than temporary. If it gaps up and then bleeds out on heavy volume, that's the rejection signature. The gap higher traps late buyers, sellers overwhelm the optimism, and price collapses back into the previous range. This would signal the 115 print was an extreme that cannot be sustained. So yes, I lean toward continuation if the market keeps behaving like acceptance, but I will not call it a guarantee. The chart will tell us this is the discipline required to avoid getting trapped by confirmation bias. You have a hypothesis. Acceptance is occurring and continuation is probable. But you remain open to contrary evidence and willing to revise the hypothesis if price action contradicts it. Here are 5 confirmation signals you can track. Receipts first, not feelings. Number 1. Price holds gains after the opening hour. If Shanghai opens at 114 and closes near 114 or higher, that confirms. If it opens at 114 and closes at 108, that refutes. Number 2, volume supports the up moves more than the down moves. When price rises, volume should be moderate to high showing participation. When price falls, volume should be light showing lack of selling pressure. This volume pattern confirms buyers are in control and sellers are not aggressively fighting the move. Number 3, no sharp reversal candle late in the session. Sometimes acceptance appears genuine for most of the day, then late selling creates a large bearish candle that closes near the lows. This late session reversal often signals that smart money is fading the move and warns of rejection ahead. Number 4, Shanghai stays elevated versus other benchmarks. The spread doesn't instantly collapse. If Shanghai trades at 115 while COMEX quotes 103, that's a $12 premium. If this premium persists into next week, it confirms physical demand in China is genuine. If the premium collapses to $3 or $4 within days, it suggests the Shanghai spike was temporary dislocation rather than sustained demand. Number 5, signs of physical friction stay present, not necessarily chaos, but persistent tightness signals. Dealer premiums remain elevated, delivery times stay extended, product availability remains constrained. These physical market indicators confirm that paper price moves reflect underlying physical reality rather than just financial speculation. 2 or 3 of these lining up is confirmation. If most of them fail, the move may have been temporary. This framework prevents you from getting emotionally attached to a narrative. You let the evidence determine whether the acceptance thesis is valid or whether revision is needed. This is how silver escapes price control, not all at once, region by region. First, you see acceptance in places where the metal is tied to real consumption and real physical demand. Then supply has to respond. And then the rest of the world adjusts. It's not because someone changes a narrative. It's because inventory reality forces the update. The market doesn't ask permission to reprice. It just does it, quietly, locally, physically. This regional repricing process is exactly how previous commodity regimes ended. Oil in the 1970s transitioned from Western price control to OPEC price setting through regional divergence. Different markets paid different prices. Supply gradually shifted toward highest bidders, and eventually the old pricing mechanisms became irrelevant as new price setters emerged. The same process appears to be unfolding in silver, with Shanghai potentially emerging as the new price setter due to its combination of physical demand, industrial consumption, and willingness to pay replacement cost. People ask, if this is real, why don't we see fireworks immediately? Because real repricing often starts as silent pressure. Pressure builds in spreads, in delivery windows, in inventory categories, in replacement costs, then price updates later when it has to. So if you're waiting for the market to announce the reset has begun, you'll be late. The reset begins when behavior changes and then repeats. This chart is one behavior change. The question is whether it repeats. Let me explain what silent pressure looks like in practical terms, because most people focus on price while missing the structural indicators. Silent pressure appears as widening spreads between futures months. It appears as basis relationships inverting into backwardation. It appears as open interest building at higher strike prices. It appears as correlation breakdowns where silver stops following gold or other metals. These technical indicators reveal stress before price fully reflects it. Silent pressure also appears in the physical market through subtle changes that are easy to miss. Product mix shifts as certain forms become unavailable. Dealers adjust websites to show made to order rather than in stock. Minimum order quantities increase. Buyback prices rise relative to sell prices, narrowing spreads. Payment terms tighten as dealers become less willing to extend credit. None of these changes generate headlines, but collectively, they signal the physical market is under stress that price has not yet fully captured. This chart is calm, and that's why it matters. Calm at higher prices often comes before the next step, not after the last one. If the move were finished, you'd usually see the market reject it. Here, it's sitting with it. Now let's bring this back to the stacker lens. If you're stacking physical, you're not trading a candle, you're reading conditions. The question isn't how do I time the perfect dip? The question is the market accepting higher prices, and is that acceptance spreading? Because if acceptance spreads, availability becomes the constraint, not your opinion about the chart. So you watch signals, you watch friction, you watch whether the market can stay comfortable at higher levels. And if you want to know whether acceptance is real, stop staring at the quote and watch friction. Here are the friction signals that show up when physical is tight. You start seeing made to order replacing in stock. Delivery times extend, days become weeks. Fewer weight options are available. Small units reprice faster than large bars. Retail per ounce math refuses to follow spot down. And you see frequent out-of-stock refreshes or quantity limits. Those are not memes. Those are market mechanics. Let me give you specific examples of how these friction signals manifest. You visit a dealer website on Monday morning. They show American Silver Eagles in stock at $7 over spot. You check again Wednesday. Same product now shows $10 over spot, delivery in 4 to 6 weeks. By Friday, it shows made to order, contact for availability. This progression, in stock to delayed to made to order, is friction manifesting as price moves higher and physical becomes scarce. Or you notice that 1 ounce rounds that were readily available at $3 over spot now have quantity limits of 100 ounces per customer. Dealers implement limits when they're concerned about running out of inventory before they can restock. The limit signals they're selling faster than they can replace inventory, which confirms strong underlying demand that spot price might not fully reflect. Or you observe that 10-ounce bars are trading at lower premiums per ounce than 1-ounce coins, which is historically normal. But suddenly the premium difference narrows dramatically. 1-ounce coins that typically trade $2 per ounce higher than 10-ounce bars now trade only 50 cents higher. This premium compression signals that small unit demand is overwhelming and dealers are rationing supply by pricing small units less attractively relative to larger bars. If Shanghai is comfortable holding higher silver, supply will chase it. And when supply chases the East, Western paper loses leverage, not because the West stops trading, because the West stops setting the only price that matters. Price discovery doesn't move overnight. It drifts. And then one day people look back and realize the anchor moved. This drift is imperceptible day to day, but obvious in hindsight. You don't wake up one morning to headlines saying price discovery has shifted to Shanghai. Instead, you notice over weeks and months that Shanghai premiums persist rather than resolving. You notice miners increasingly contracting with Eastern buyers. You notice refining capacity expanding in Asia while stagnating in the West. You notice ETF flows reversing as Western investment vehicles see outflows, while Eastern physical demand surges. All these small changes accumulate into a major structural shift that becomes undeniable only after it's largely complete. Here's the key point again. This chart is calm, and that's the signal. Calm at higher prices usually comes before the next step, not after the last one. So here's what I'm watching next, the next proofs. Does Shanghai hold above the breakout zone into the close? Does volume stay supportive on advances? Do spreads stay elevated instead of collapsing instantly? Do friction signals persist? And do other venues echo the same acceptance behavior? If those align, the pressure story continues. If they don't, we treat it as a temporary event and we move on. That's the advantage of proof-first thinking. You're not married to a story. You're married to the evidence. This intellectual discipline is what separates successful market participants from those who lose money. The unsuccessful get emotionally attached to narratives and ignore contradicting evidence. The successful remain flexible, updating their views as data changes and avoiding the trap of confirmation bias. Let me give you the practical implications for different types of participants. If you're a long-term stacker accumulating metal for insurance purposes, this chart tells you that your thesis is validating but doesn't change your strategy. You continue dollar cost averaging into physical at whatever prices prevail, recognizing that timing exact bottoms is impossible and unnecessary for long-term holdings. The acceptance at 115 confirms the repricing is real, but you're not selling regardless of whether price goes to 130 or pulls back to 100. If you're a trader using futures or options, this chart gives you important information about momentum and market structure. The acceptance signature suggests that long positions have probability of continuation rather than immediate reversal. But you must remain disciplined about risk management, using stops and position sizing that allows you to survive if acceptance proves temporary and rejection follows. The chart leans bullish, but doesn't guarantee outcome. If you're an industrial consumer needing physical silver for manufacturing, this chart is a warning to accelerate procurement or lock in supply contracts immediately. The acceptance at 115 suggests prices are unlikely to return to levels that prevailed 6 or 12 months ago. If your procurement strategy assumed silver would remain range-bound between $70 and $90, that assumption is now questionable. Better to secure supply at 115 than face 140 or potential availability constraints later. All right, what changes for stackers this week based on this proof? Signal to watch: calm acceptance above key levels in Shanghai. Trigger: holding gains after the open and into the close. If I'm wrong, a sharp reversal on heavy volume, the rejection candle, the fast give back. Don't overreact to one print, 1 hour, one headline. Next proof: does this acceptance spread region by region? That's the dashboard, not your emotions. This framework keeps you focused on what matters. One dramatic candle means nothing. A pattern of acceptance across multiple sessions, multiple venues, confirmed by physical market friction, that means something. Your job is to watch for the pattern rather than reacting to individual data points. Let me end with the perspective that puts this all in context. Silver crossed $100 recently. The market briefly touched 115 in Shanghai. These are extraordinary developments that very few analysts predicted. But more important than the numbers is the behavior around the numbers. Does the market panic and reverse, or does it accept and consolidate? The answer to that question determines whether we're seeing a speculative blow-off or a fundamental repricing. This chart suggests acceptance, the calm holding of gains after dramatic advance. The volume patterns showing conviction, the absence of violent rejection signatures, all of this leans toward fundamental repricing rather than speculative excess. but we need confirmation through time. 1 or 2 days of calm acceptance is interesting. 2 weeks of calm acceptance becomes significant. 2 months of calm acceptance confirms regime change. Your advantage is understanding this distinction. Most participants will react emotionally to price moves without asking whether the market accepts or rejects new levels. You have the framework to ask the right question and interpret the evidence correctly. This gives you edge, not perfect foresight, but better odds than those trading on emotion or narrative. If you want proof over hype, track these signals. Watch whether Shanghai continues holding gains. Watch whether spreads persist or compress. Watch whether physical friction increases or decreases. Watch whether other venues begin exhibiting similar acceptance patterns. These receipts will tell you whether the acceptance is spreading and strengthening or whether it was temporary anomaly that will reverse. Comment one thing. Do you think this is acceptance or a temporary anomaly? Your perspective helps everyone watching these developments unfold. Stay sharp, track the proof. And remember that in markets, the calm is often the signal, not the chaos.